Thank you so much, Prabhakar sir, for giving us this opportunity to host you. Everybody who's attending this session is our alumni or current batch enrolled students. The intent of this session, which we thought would be to learn how to analyze businesses from you, and we're really, really privileged to have you as over the guest talk, sir. Thank you so much. Without any further ado, over to you, sir.
Yeah, my pleasure. My pleasure. Thanks. So I was told that I can talk about my investment journey and the process, and then we'll follow that up with some questions. Right? Is that how it's going to go?
Yes, sir. Basically, so the threefold things which we were really excited to learn from you is how to go about generating investment ideas, in terms of how to identify right time to buy a stock. On second, how to analyze a small cap and mid cap especially, and to get a sense, the third point, to get a sense where the markets are headed. So those were the threefold things which we're hoping to learn from you in the the first 45 odd minutes, keeping things in mind of your calendar. And then we have few questions already. We have received few questions already from our students, which we have shortlisted, and maybe focus on those Q&A answers at the end, if you'd allow.
Sure. So, see, the way I've planned this is I want to talk about 3 or 4 very important concepts, right? Which really helped my own investing journey, in a massive way. And I'm sure that, a lot of you who are starting in the market or who are somewhere in the middle of their journeys, should definitely benefit from it. So those are the 3 or 4 key concepts or points I wanted to cover. And then we can probably follow that up with, the Q&A. So that is how we would structure it. So let me start off, right? So the first thing is, like they say, there are many, ways to get to heaven, right? Similarly, there are many ways to make money in the market, right? It is one of the most important things that we all need to, appreciate. And I am sure all of you know that, right? So there are many different ways of making money in the market. But what, some of you may or may not appreciate is the fact that eventually, if you want to be successful in the markets, you have to pick one way. You have to zero in on, you have to experiment with a lot of things. But finally, you have to select one type of, investment or one type of trading, or, you have to zone in on something and, go all in on that. That is the only way you can gain mastery in the markets, right? So it is, because see, markets are a very competitive, endeavor. Because, end of the day, everybody who is working in this world is working for money, right? And the markets are the temples of, capitalism. So it's a very competitive game. So unless you get really good at it, your results will always be mediocre. So the way to rise above the mediocrity is to experiment with a lot of things while you are young and while you're starting out. But eventually you have to figure out that, okay, this is the one style, or this is the one type of strategy I will pick, and this is what I will dedicate my time and efforts to. That is most important. If you do not understand this concept early on in the game, then you can spend your entire investing career and end up with only mediocre returns. And this is true of anything in life, right? Even if you talk about religions, right? So there are different religions. All the religions essentially talk about the same things, right? So but you cannot be practicing multiple religions at any given point in time. You have to pick one that resonates with you, or that you're born with, or whatever it is, and you have to use that path as your guide to God. So similarly, in the temples of the market also, you have to pick one path, and you can experiment with many. When I started out, I experimented with many different things, and finally I have zeroed in on something, and that is what I've been dedicating my life to over the last many years. And the difference in the performance, the difference in the amount of success is massive, once you figure this out. So the question is, how do you figure out, what is, practically, how do I figure out which path to take or what style to, go for, right? A simple question that you have to ask yourself is, what time frame do you want to play the game in? right? So I keep calling this market a game, because that is what it is. At end of the day, it's a game of probabilities. It's a it is not, there is no formula here, right? So there is, just like how sportsmen play their sport. We this is a sport for us, right? This is where we have to practice, we have to compete, and we have to win, right? So in this game, you have to figure out which time frame do you want to play. This is the most important question that you have to answer, because there are different time frames in which people operate. There are very successful intraday traders, there are very successful swing traders, there are very successful positional investors, there are very successful long-term investors, right? So the number one question that you have to answer is, what is my time frame, right? Which time frame suits my personality, which time frame suits my day-to-day lifestyle, right? Because let's say you are working and you are interested in the markets, right? So you cannot then be an intraday trader, because intraday trading requires a lot of screen time. You have to sit in front of the terminal, and every tick you have to watch, right? So depending on what type of a lifestyle you have and what resonates with you, you have to pick what is the time frame that you want to trade. And this time frame will define everything. This time frame will define your risk management. This time frame will define how you construct the portfolio. This time frame will define the strategy. This time frame will define the setups that you trade. So first and foremost, figure out, am I playing an intraday? Do I want to play intraday? Do I want to play a swing trading kind of a thing? Or do I want to play a positional, investing or trading, like I want to hold for a few months to a few, years? Or do I want to play the multi-year, multi-decade kind of a game, right? So there are different kinds of investors. And if you sit back and analyze all the great investors, you will see that they've all picked one style and they have mastered it, right? So if you look at the Warren Buffetts of the world, right? So he has picked up a very, very long-term type of an investing, style. And suiting that long-term horizon, he has structured everything around it, right? So whether the way Berkshire Hathaway is structured, the way the float is structured, right? He's got locked in long-term money, and that is why he's able to invest in long-term, assets, right? And he gets opportunities once in every few years whenever there is a market correction or a crash, right? So there is a specific style, a specific time frame that he has chosen, and the reason for his success is that he has mastered that, right? So similarly, if you look at other traders like Stanley Druckenmiller, right? So he is more of a positional trader, right? So they own positions which last a few weeks to a few months. So they trade like that on Twitter and all that. Although there are a lot of fake people and traders out there, but there are a very good intraday traders that are out there. People who have mastered that and dedicated their life to sort of intraday trading, who are able to do really well on the intraday time frame. So the idea is, pick something which is which resonates with you, and then you have to master it. You have to master the nuances of it, because once you pick a particular time frame or a strategy, it is very important to dive deep into it. There is no running away from it. You cannot be a surface level knowledge person in any endeavor, and definitely not in the markets, unless you dive deep into a particular strategy or a particular setup. You will not be able to outsmart the markets. The markets are made up of very, very competitive people, like I said earlier, and you have to understand all nuances of your strategy. Like, when will the strategy work the best? When will the strategy not work? What type of a portfolio I have to construct that suits my strategy? What type of a risk management? So if you remember famously, right, Warren Buffett stayed out of the 2000 tech boom, right? It was because he was very clear what is he trying to do, right? So he is investing in companies where he doesn't like change. He's investing billions of dollars into enterprises where he can predict what their balance sheets and P&L statements will look like 10 years out. And that is the reason why he did not invest in technology, because he could not predict what those numbers will look 5 to 10 years. So you have to be very, very clear and nuanced in your approach to know what am I trading, and how am I going to sort of go about it. So that is the first part of it, right? So you have to experiment with a lot of things while you are young, but eventually you have to pick one strategy and go for the mastery of that strategy, right? The next part is coming to me, right? So this is the general stuff I told you. Right? So personally, what I have done is, so I have picked the time frame of 3 to 18 month period, right? So this 3 month to 18 month period is my sweet spot. So I generally believe that in the market, based on the research that I have done, that if you study a lot of big winners in the market, generally this re-rating phase of any stock is spread out across in 3 to 18 months, right? 3 months to 1.5 years is when the big re-rating happens. You can go back and look at any of these charts and study this. So there is this thought in the market कि पैसा जल्दी बनाना है या ज्यादा बनाना है, right? So my question was, तो जल्दी भी बनाना है और ज्यादा भी बनाना है, तो क्या कर सकते हैं? So that is when I thought, okay, what is the sweet spot, right? So the sweet spot for me is this idea of participating in the re-rating of companies. Look for companies which are likely to get re-rated by the market over a period of 3 to 18 months. So that is the, in a simple sentence, if I have to tell you my strategy, it is that I am continuously looking for companies that are getting re-rated in the market for one reason or the other, and we'll come to that, why the what the thing is. So so before I go into how I go about it and all of that, the most important thing is you have to, whenever you pick a particular strategy, the way generally people go about it is read books about it, read books about some trader, read books about how they did it, read Warren Buffett, read his letters. All that is okay. But I'm giving you my raw experience, right? So my raw experience has been that whenever you want to learn about a strategy, you have to do what is called as a precedent analysis. I think Mark Minervini calls it the precedent analysis. Different people call it different things. Some people call it a deep dive, right? So basically, whatever time frame you are trading, you have to go back and study hundreds of examples of stocks which have performed on that time frame. So if you want to learn about, if you're a fisherman and you want to learn about the nature of the fish, right? You can read 1,000 books about it, but you will be outsmarted by a guy who watches what fish do in the sea for 100 hours or 1,000 hours, right? So it is very important that the real truth is there in front of us, but we keep looking for it in hundreds of books. So if you're an intraday trader, right? So this is not a trading thing, but I'm just saying this applies everywhere. If you're an intraday trader, you have to study continuously, hundreds of thousands of charts of significant intraday moves. How did those moves happen? When did they start? What was the trigger? How did they play out? When did they end? All of those answers are right there in front of you. And that is what you have to spend your time studying. You have to do hundreds. So what then happens is these patterns, become a part of your subconscious mind, right? So what I have done is, like I said, this 3 to 18 months time frame. I have gone back and studied, 3 to 18 months time frame, the best performing stock over the last 10 or 15 years, right? It's a project. It's an ongoing project. So when you go and study and you ask these questions, okay, this stock made a 400% move. So let me go and check, when did this move start? What was the trigger for this move, right? How did this move, go about? What was the drawdown in the middle? How much was the, how much did it fall? Because the journey of 200, 300% will not happen in a straight line. There will be a 30, 40% move. There'll be a 20% pullback. And again, there'll be another 30, 40% move. That is how stocks move. So you will then realize what exactly really is happening in the market, and the insights that you get from that will really, those are the game changers. You will not find this in any book, right? So these are the insights which you will learn on your own, and they will become a part of your subconscious. And that is how the greatest investors operate. If you look at Warren Buffett, people say that you go to Warren Buffett, you give him an idea and he can decide in 5 seconds, right? So this 5 seconds decision making So this 5 seconds of decision making has happened because Buffett has studied so many businesses and valued so many businesses that the template or the pattern is imprinted in his mind. So the moment he sees it, you go to any good trader, the moment they see a chart, they will tell you what's going to happen. Of course, it's a probability, but their hit rates will be 5 or 6 or 10 times better than a normal person or a lay person, right? So the game here is that the game here is whatever strategy you pick, you have to do a precedent analysis of that, and that will give you so many insights and nuances which no trader can tell you, right? So if you read Mark Minervini's book, you will not. Why do thousands of people read Mark Minervini's book, but hardly a fraction of them might become good traders. And the fraction of them, what different they do is this: they actually go back and study how stocks move. And that is exactly the study that I did on this time frame. And the 3 to 18-month time frame, where stocks have made moves of anywhere between 50% to 300, 400, 500%. Right. So I went and studied this and did this across many years. And what I found out was every move starts with a catalyst. Right. There has to be, every big move needs a catalyst. Stocks do not move randomly. Every move will require some sort of so what are these catalysts, right? So these catalysts can be a surprising earnings announcement. This catalyst can be a government regulation which is good or bad for the sector. This catalyst can be a management change, or this catalyst can be a new product, or it can be any news. But any news which materially changes the future perception of the earnings of the company is a powerful catalyst. And that is the secret behind every big move. You show me any big move in the market, there will be a catalyst behind it. And what is our job as investors is to find out that catalyst as early as possible, right? Not only find out, but also figure out if it's a material catalyst. And then once you realize that it's a material catalyst, you have to then allocate money to it, right? So that, essentially is so several examples of that, right? So in the recent past, I'll tell you some of these we participated in also. So earnings surprise is something that I use a lot, right? This is when a company which was not doing anything suddenly comes out with blockbuster earnings, right? So that is when you have to sit back and take notice that, okay, what's changing here? So is this a sustainable trend? And if you figure out that it's a sustainable trend, you can go out and allocate money to it. So go back and study the earnings of stocks like Apar Industries, right? Last 1 year's biggest winners, if you go back and see, all of them will have a catalyst. So, Apar, or look at Nucleus, look at so many stocks, right? So earnings winners are stocks like this, right? Government regulation change, right? Defense was the biggest government regulation change which happened 6 months back. People are waking up to it now. But if you are tuned to catalysts, then you could have participated in a Masground Doc or a GRSC or the HALs and the BELs of the world 6 months back. So if you're attuned to this concept of catalyst, then you will know that once a catalyst enters a picture, the stock has to come on your radar, and you have to figure out what is this catalyst a game changer. If it is a game changer, you have to go out and allocate to it, right? Similarly, management change, right? Look at CG Power. CG Power was a very bad management, right? The stock went bankrupt. The stock was at 5 rupees. When the stock was at 5 rupees, who took over? Murugappa Group. They are one of the managements which is considered as a gold standard in the markets. The moment Murugappa Group took up, the stock started hitting continuous circuits, and the stock from 5 rupees non-stop went up to 30 rupees. And the catalyst, and the beauty of these catalysts is that they don't get over in a day. The catalyst, once a big catalyst enters a picture, you need not enter on day 1. You can enter on day 10, you can enter on day 30, you can enter on day 60. There is a threshold up till which you can go and enter them. And CG Power today is at 400 rupees. So the stock has moved from 4 rupees to it's almost 100 bag, right? So obviously, very few people were able to buy it at 4 rupees and sell it at 400 rupees, right? But it was very easy to buy that stock at, let's say, 50 rupees or 40 rupees, because by then, this news was very much out there. And you knew that Murugappa Group is very good. And this company, which was bankrupt, they would completely change the, fortunes of this company. And that is exactly what happened. So that is my strategy. You need not follow it, but I am just, using my strategy as an example to show you how you have to zero in on something, spend thousands of hours trying to understand the precedents, in your particular chosen strategy, and go out and allocate, right? So our job essentially is to find these catalysts, understand how material they are to the company, and figure out what it means for the future earnings of the company, and if possible, try to extrapolate and figure out the future earnings of this company. So how do you do this, right? So how do you figure out how can you be attuned to these catalysts, right? So basically there are three main ways, right? Three main sources, if I can tell you. One is you have to track corporate announcements. You have to religiously track corporate announcements. You have to religiously track quarterly results, and you have to religiously track news. So since all of you are interested in the markets, I'm sure you do this, but I am sure you do this in a very ad hoc manner, right? The secret is you have to do it religiously, right? The secret is not, once it comes on Twitter and, but now Twitter also is a reasonably good source, because everything is so fast nowadays that, you can even use something like a Twitter, and if you follow the right handles, then, there's so many good people who, keep, summarizing things and summarizing corporate announcements, talking about news. So, but you have to be attuned to the market, because you don't know when the opportunity will strike. And once you find a catalyst, there are multiple entry points to, get on the train. If it's a big enough catalyst, then you will get multiple entry points to get into the train, right? This is how you find the catalyst, right? So how do you figure out whether it's a material catalyst or not, right? How do you figure that out? So that obviously needs some experience and work. So let's say, so I have been doing this for many years, so I've got a sense of the quarterly results of a lot of companies and all of that. But if you do this for 4 or 5 quarters continuously, you will also very quickly come to a stage where you will be able to figure out whether an earnings announcement is a surprise or it's not a surprise, or how material is it, and all of that. The second thing is you have to look for, once one company declares very good earnings and another company in the same sector declares very good earnings, you can be very sure that this is a sector level change that is happening. And so you can then really back up your truck, because then then it's not like some odd man out kind of a thing, right? It's multiple companies, so the entire sector is undergoing a tailwind. So that is one of the ways. You should obviously look at con calls, right? A lot of analysts attend con calls to plug in their Excel sheets, but the smartest investors attend con calls to get insights from the management or clues about the future earnings, right? So a lot of times managements talk in a very subtle manner. Sometimes they talk explicitly, sometimes in a subtle manner, which will give you clues as to what is likely to be the trajectory of the earnings over the next few quarters. And that is invaluable. So reading con calls is, and obviously you need a lot of common sense, right? You need a lot of common sense, right? It is in the sense that if a management, is making some claim which is too good to be true, you should be smart enough to, unless it's a management that is very trustworthy, right? If it's like, one of the recently listed managements, which is making some big claims which don't pass the common sense test, then you have to be a bit skeptical, right? Because managements will always talk bullish. Management will always talk bullish about their company. They will always be optimistic. But it's your job as an analyst to figure out, has the train run its course, or is it a 1 quarter wonder, or what exactly is it that whether it is feasible or not. And that is why I said all of these other clues, like if multiple companies in the same sector are doing well, then you can be reasonably more sure that, okay, what this guy talking makes sense. So look at the electronics manufacturing space, the EMS space, right? So a lot of companies are there. Now, if one guy was talking about a 40-50% growth rate, and that guy is a newly listed guy, all of them are newly listed, but if the entire industry is talking about that kind of a growth rate, then you can be more confident. You see the difference. So if one guy is talking, he can be a liar, but the whole world can't be a liar, right? So when multiple companies are talking about it, that's your clue, right? So this is about, how, you should be attuned to the, it's a very large topic, and, I don't think I can cover it. The lot of nuances. Like I said, you have to go all in, right? You have to go deep into this and do it yourself, and you will understand a lot of things. And, if you have any questions, you can sort of reach out to me, separately. But that is the second concept, right? The first concept I told you is find one strategy, what is your religion, one religion as far as the market is concerned. Find one thing and go all in on that, because to succeed in the markets, you have to become an expert at something. And the second thing I told you is about, how you, once you find something, how you can become a master at it. It is by doing precedent analysis, historical precedent analysis, or deep dives. How has that exact same thing happened in the market? You have to study. Only then you will know the reality. You will not know the reality from the books. And the third concept that I'm going to cover, I have a total of 4 concepts. The third concept is about the idea of market awareness, right? So no matter what strategy you are running, you have to have an awareness about what is the market doing right now, because that will decide more than 50% of your returns will be a function of the market environment. So if you are in a bear market, your strategy will have a completely different, risk to reward ratio. If you're in a bull market, your strategy will have a completely different risk to reward ratio. So understanding the market environment is very, important to dial up or dial down the risk that you're taking, or how you're constructing the portfolio and so on, right? So what type of strategies you are running and on all of that, right? So how do you figure out, if it is an environment, if it's a good market environment or a bad market environment? So there are multiple ways to do this, and that is how a lot of professionals do it, right? So you have to again go back to, so the basic theme is all your answers are there with the market. All your answers are, the answers are not in a book. The answers are in the market. You have to go to the market and figure out, okay, what's been happening over the last 3 months? What's been happening over the last 6 months? What type of stocks are doing well? What types of sectors are doing well? And there is this concept of breadth of the market, like how many stocks are, it's a technical concept in the sense that how many stocks are trading, what percentage of all the stocks in the market are trading above their, let's say 50 EMA or 20 EMA, right? So the more broad-based the market is, like the current market is very broad-based. Currently, I think more than 70 or 80% of the stocks are trading above their, 50 EMA, right? So it's a very broad-based market. But if you went back to 2018-19, it was a very narrow market. Very few stocks were doing well. So the type of understanding the type of the market using breadth is very important. You have to look at other things like the global markets. You have to look at some macros like currencies, commodities, how are the, the volatility index and all of that. All of these things you have to put together. You have to look at liquidity. You have to look at, what the FIIs are doing, what the DIIs are doing. So all of these things you have to put together into, to form your view of the market. And the view simply, to answer this simple question, is how conducive is this market for my strategy, right? So if you are somebody, and that answer will differ from person to person, right? So if you are somebody who is an investor, then you will need the underlying market to be bullish to make money. No matter how good an investor you are, no matter how great your strategy is, if the underlying market environment is not good, you will make subpar returns. You might outperform all your peers, but in an absolute sense, if the market is down 10%, then your strategy at the max will be up 5%, which is a great achievement actually. The market is down 10 and you are up 5, it's an outperformance of 15%, which is a great thing, right? But in an absolute sense, if you have to make money, for any long only investor, the market has to be good. There are a lot of these option traders out there. For them, the key variable is the volatility index. If the VIX is high, then they thrive. Now, when the VIX is low, they are suffering, right? Because when the VIX is high, the premiums are high. The premiums are high, they can sell it at a high rate and make money of it. When the VIX is low, the call writers, right? They are not getting paid enough for the risk that they're taking. So depending upon your strategy, you have to understand, is this market environment good for my strategy or bad for my strategy. And accordingly, you have to tailor your strategy, and that is how you manage drawdowns. Otherwise, if you run the same formula in all markets, that is one of the big mistakes investors do. Then you will be taken for a ride. Whatever you make in the bull market, you will give up everything in the, or most of it in the bear market. Right. So the way to protect your gains is to have this market awareness on a daily or a weekly basis. You have to figure out, has the market changed? What styles are working? Is value working? Like in this market, right? Quality is not working. In this market, the old economy stocks are working, right? Or some new themes are working. Infrastructure is working. PSUs are working. The new themes like defense and EMS and all that is working, right? So you have to be attuned to the market and tailor your strategy accordingly. And finally, the idea of portfolio construction, right? So it's something which a lot of, so I also did I think, space some time back on portfolio construction. I'll encourage you to look at it. But very briefly, if I have to talk about it, then portfolio construction is not a random activity. Portfolio construction is one of the most important activities you will do. So most people randomly construct a portfolio, right? So they will pre-decide that, okay, I am a diversified investor. So I will have 50 stocks in my portfolio. Or I am a concentrated investor. So I'll have only 5 stocks. So that is not how portfolios are constructed. Portfolio construction there is a thought behind it. So depending upon your strategies, risk and reward, your portfolio has to be constructed. So to give you an example, if you are a venture capital investor, if you're a VC, right? If you're a VC, you are investing in companies which will give you either, you will fall 99%, lose your capital, or you will make 1,000%. So can you afford to be a concentrated investor as a VC? No. Now there may be a VC who will say, no, I'm very aggressive. No, I will be a concentrated investor. I'll buy only five companies. So portfolio construction is never about you. It's always about your strategy. So a venture capital investor, they have to buy hundreds of companies because one win can take care of 100 losers, right? Similarly, if you are investing in, let us say, large caps, right? If you're investing in Asian Paints and these kind of companies, right? MNCs, then it doesn't make sense to be very diversified because these companies are not that volatile, right? So these companies, if you're willing to sit on them, then you can just make a basket of 10 of these or 15 of these and be done with it. Similarly, if you're a small cap investor, you have to be diversified because a small cap stock, when it falls, it will fall 50-60%. When it goes up, it will go up 100, 200, 300%. So depending upon your risk reward profile, you have to construct the portfolios. So higher the risk reward, the more diversified you should be, right? So at one extreme is venture capital, right? At the other extreme is these very safe instruments. Like if you're investing in a government bond, right? You can put all of your money in the government bond and be done with it, right? Because although there is a black swan kind of a risk, but practically speaking, you don't have to worry about it. You can just put everything in one stock and sit. But if you're a VC, then even 100 stocks might not be enough. So when you're constructing the portfolio, this is what you have to think about. So for me, the kind of investing that I told you I do, where I try to play this, 3 months to 18-month kind of time frames, and I typically operate in the mid and small cap space. I find that a number of 25 to 30, 35 stocks is where the sort of sweet spot is for me. So that is what I follow. And diversification, I've found over the years, has many other benefits, right? So obvious benefit is the risk mitigation, right? So if you're better off with the 25, 30 stock rather than 3 or 5 stocks, because any mistake will not be very costly. That is very obvious and simple, right? But there are a lot of other ideas. One is optionality, right? So when I say optionality, a lot of times the best performing stock in your portfolio will be the stock you completely neglected or ignored, right? Because that stock, if you go back and study your portfolio, at the beginning of the year, I asked you to predict which stock will do the best and which stock will do the worst. The one you thought will do the worst actually might be in the top quartile in terms of performance. And ones which you thought will do the best might actually be in the bottom quartile, right? So diversification gives you optionality. Diversification opens up your portfolio for surprises, right? Sometimes events happen which suddenly bring a stock, in favor, right? So optionality, it does that. And second is, in a broad-based bull market, diversification really helps, because a broad-based bull market works by what is called a sector rotation. So money will get into a sector, stocks of that sector will go up 20-30%, and money will go to the next sector, and this sector will go into consolidation mode, and the next sector will go up 20-30%. So if you have a diversified portfolio, different parts of your portfolio will keep performing, and your portfolio will keep inching up. Whereas if you're a concentrated investor, you will only participate when your stocks are running. So in a broad-based bull market like the one we're currently going in, a diversified portfolio is really a game changer. So 4 points to conclude, and I've spoken a lot. So one I said is, find one strategy that you want to focus on and go all in on that. Second thing I told you is to do deep dives, right? So deep dives on that strategy. So if you're on that time frame, whatever time frame you pick, study 50, 100 case studies of that time frame and figure out what exactly, how have those stocks moved, right? And the third thing I told you was market awareness. Understand the concept of market awareness and its relation to your strategy, right? And you have to dial up and down the risk based on that. And the fourth is the giving importance to portfolio construction. Portfolio construction has to be a function of your risk reward. It is not a pre-decided thing. Your strategy should define your portfolio construction. So remember these 4 points, and I mean, these 4 points have been the game changer for me. And I'm sure if you pay attention and you are able to apply this, it will really take your investing, into the next orbit. So that's all my introductory, talk.
Thank you so much, Prabhakar sir, for a detailed walkthrough. We do have few follow-up questions on chat from a couple of our students, and we, what we did basically, some of the students went through your material, which is available already online. The write-ups which you have written, and they have given up follow-up questions on those. So, which one should we get started with first, sir? With your permission.
Anything is fine, not a problem.
Fair enough. So I think for the topics which you just walked us through, there's one follow-up question from one of our students, Ankit Pincha. His question is, on many occasions, catalysts don't impact, prices, or rather they don't become active till a certain moving point has come, right? How do we filter out in that scenario where the impact has taken up after a huge lag? And what do we do in such scenarios where the catalysts haven't really started or initiated a reaction in any manner?
No, my experience has been that, see, there are many catalysts that you will encounter on a daily basis. But like I said, it's our job to figure out if it is a material catalyst or not, right? So now let us assume that the catalyst that you're talking about is a material catalyst, right? Now, definitely, unless the market agrees with it, you will not make money. You might feel it's a material catalyst, but the market is so competitive that if the catalyst is really material, it will definitely have an immediate impact on the price. And the only time it will not have an impact on the price is if we are undergoing a bad market environment. So that is where the market awareness point comes into the play. In a bad market environment, a lot of times good catalysts will not move the stocks, right? But once you've identified a good catalyst in a bad market environment, those are actually, if your analysis is correct, then those are the actual multi-bagger opportunities. Because in a bad market allows you to pick up stocks which are going to do very well on the earnings front over the next few quarters. And just because of the bad market, they are being kept down, right? So you will be able to enter a stock that has no froth, and you will be able to make the most of it. Otherwise, what happens is, in a bull market like this, the catalyst comes into play, very quickly the stock will move up 20-30%. Before a novice trader even figures out what's happening, the stock will be up 50%, right? So you can only get on the train slightly much later. But a bear market is actually a great opportunity if you are skilled at recognizing catalysts So that is the only time the stock on a good catalyst will not move. But if you're in a bull market and you think it's a good catalyst and the stock has not moved, within, let's say, a week of the news, then it's your analysis that is wrong. You have to work on your analysis. But if it's a bear market, then it becomes tricky because you will not know whether an analysis is right or wrong. Because in a bear market, even a good catalyst will not work out. So, but the context is important.
Fair enough, sir. So just sharing my screen. These are the list of questions which we got from most of our students from the reading material. So to start with, on one of your blogs, so you wrote about a framework to instantly take stock analysis to another level. You mentioned that management should have good execution. So the student's question is, how do we judge or get an idea about the execution of the management, whether it's able to execute its decisions well?
Yeah, so basically it's the track record, right? Basically it's like I gave you the example of CG Power and Murugappa Group, right? So why did the market re-rate CG Power? Because Murugappa Group is known to be a very good management. Now, why is it known to be a very good management? Because they have run multiple other companies and they have created wealth for the shareholders. The simplest way to find out a good management is where you can within 5 seconds find out if the management is good or not, right? Is to check two things. One is go to the monthly chart of that particular company, and if it's steadily going up from left to right, then it's a good management. Because over multiple cycles, it is very difficult for a bad management to survive, right? Because if a company has survived multiple cycles, right? So let's look at examples like Pantaloon Retail and all. They were all one cycle plays, right? They were all one cycle plays. They did very well from the 2003 to 7 cycle, and then it was a downhill for them, right? Or if you look at the Anil Ambani stocks, the Reliance Capital and that group, or if you look at any of these stocks, right, whether the Vakranjis of the world or anything. So a stock like HDFC Bank, Asian Paints, why are they valued? Because these managements have navigated multiple cycles. So if you see a chart of a company which is steadily going up from left to right, assuming it's a non-cyclical company, then you can be very sure that the management has done well. Right? And the second thing is, typically within the sector, a good management will generally have a very high return on equity. So if you look at the return on equity, so the return on equity in absolute sense need not be high, but within the sector, the company which is the leader or the company which is having the highest return on equity, you can be reasonably sure that it's a well-managed company.
Fair enough. Thank you so much. The second question is, you talk about stories which lead to stocks becoming winner, right? So how do you apply the TRAPP attributable to those stocks who are becoming winners due to change in perceptions or maybe due to a structural change which is happening in the economy?
Yeah, so see, by definition, stories and structural change or change in perception are two opposite things. So when I spoke about stories, right? So I spoke about catalysts to you. No, I did not talk about the stories aspect of it. So I spoke about the major catalysts like earnings, management change, or government regulation, or new products, or something like that. But one of the other biggest catalyst for a stock move is stories, right? So by definition, stories are stories, right? So stories are news items which may or may not be true, okay? But because those stories are changing the perception of how the stock will do in the future, the stock starts getting re-rated, right? So it is not a structural change, and it is not a permanent change in the the nature of the stock or the nature of the management. So stories are to be strictly played with a trading mindset, right? So like let's take the example of, let us say, the Adani Group, right? Now the Adani Group has done very well in terms of there was a time, but it was a pure story, right? Because the numbers were not there on the table. It was a pure story in the sense that it was a hope that this company, because of X, Y, and Z, will eventually do very well, and the numbers will come, and this will happen, and that will happen. All right. So anybody who participated in Adani stocks with a trading mindset came out of it unscathed. But if you got confused, because see, unless the numbers are not there, unless the reality is not being reflected on the P&L or the balance sheet, it is a story. And stories have to be treated differently. So we should not confuse a story and make it a part of our buy and hold portfolio. So stories will typically not even last for 18 months. Stories will get over in 3 to 6 months. So Adani was an exception, right? But even that story eventually came to an end, right? So stories and structural change are two different things. So as far as possible, I would say if you're a new investor, avoid story stocks, because you need a certain level of expertise to understand that it's a story, still participate in it, and have the ability to get out of it at the right time. Right. So as an investor, do not get into story stocks. As a trader, you can get in and make money, then nothing like it.
Fair enough, sir. Thank you so much. The next question is on stocks with high allocation in the portfolio. Let's say you have started with a 8 to 10% allocation. You have a really good conviction. It turns out to be a multi-bagger, and after some point in time, the stock suddenly is 20-25% of your portfolio, and now the company has a good growth outlook, but the valuations are reasonably expensive. Let's say you follow a reverse DCF approach and you try to see that that kind of growth doesn't really make sense anymore. And let's say you decide that at this stage, how do you basically take a call whether to keep the stock or trim down the position or bring the weight down to a particular number which makes sense? And like, do you have a thumb rule which you follow that this is the maximum allocation I'm going to allow this particular this particular stock or any particular stock, as a matter of fact?
Yeah, I think typically there are 2-3 ways. They are not scientific ways, right? But there are different ways in which traders or investors look at this. So I remember reading a very old interview of, I think, Rakesh Jhunjhunwala or Nimesh Shah, some of these great investors, and what they suggested was that let us say a stock has become a multi-bagger and it has gotten in. So there will be a phase in the stock where it is justified by the numbers, and then it will get into a phase where it goes into a euphoria kind of a zone, right? So the investor has to, like I said in the previous answer also, the stock suddenly from a fundamentally good stock becomes a story, because the investors start extrapolating that into infinity, right? So there is a very thin line between that, but typically, let us say you are going through that phase, right? If you figure out that the stock has gotten into a euphoric phase, where it's just going crazy and people can't get enough of it, right? It happens every once in a while in our market, right? So it happened in the dot-com boom. It happened recently with a lot of chemical companies and all that in the previous cycle, right? Whereby people think that the P ratios just go through the roof. So what the smart investors do is they change their characteristic from an investor to a trader with such stocks, right? So whatever is the excess, right? So they then trail it with certain stop losses, or they sell into strength. So so it's more of an art. There is no clear cut answer, right? So it depends on the context. So if it is a stock which is a very stable business, which is not getting euphoric. So there's a difference between euphoria and high P, right? Euphoria is something where within a very short period of time, the stock makes a very large move, right? Typically, it happens in stocks which are low float stocks and all of that. They may be good companies, but something like that happened in DMart, I think last year or something, where the price went non-stop for a month or so, and in a month or so it went up 50-60%, and that high is not seen even today, right? It will eventually be seen, but you have to figure out, are we dealing with a euphoria situation, or are we just dealing with a high PE situation? So if you're with a euphoria situation, then you have to take a trading mindset, and whatever is the excess quantity, right? The base quantity need not be disturbed. So let us say I am okay with having 15% or 18% of this stock, but let's say it has become 25% now. So I have that extra 7-8%. That extra 7-8%, you have to keep selling into strength, or you have to have some trailing stop loss or some methodology to manage that, right? But if it is a high PE situation, right, whereby the high PE is sustaining, then as long as you feel that the company will remain a high growth company, you have to continue to own it, right? And this is a problem that happens in bull markets. If you go back and study bull markets, the best performing stocks will always be high PE stocks. The stocks will always look expensive to the normal janta, and the growth rates, but the difference is the growth rates will be very high. So the growth rates will be 35, 45, 55% per year, but the P will be 50, 60, 70. So if it is that kind of a situation, and you are confident that that we are not very late in the cycle, right? You've gotten into something early, and you're not very late in the cycle, and this company is showing these kind of growth rates only for the last 1 or 2 years, then you have to sit with that 25%, because if you sell that, it will be one of the biggest mistakes of your career. But if we are 6-7 years into this high growth phase, and then this problem is coming to you, right, then you have to start pruning. So it's very market, right? That's the problem. In market, there are no straight answers, right? There are no straight answers, all context dependent. So I can't give you a rule of thumb and say, do this, right? Let's say you've gotten into something at a bear market low, right? And you allocated 8 to 10%. And in a matter of, let's say an year, you have got a 2-3 bagger, which is what happened for people who had the guts to invest during COVID, right? So essentially what happened is the fall just got negated. The stock is back to the level where it was in February 2020, right? So at that point in time, that, you've gotten in early, and you've caught a very good, situation. So that is the time when you have to ride it. But if you're too late into the bull market, and then you're sitting on these kind of allocations, then you have to think about pruning them, or at least getting some money off the table. So it's very dependent on where we are in the context of that company and in the context of the market. Sorry, because that's the truth, right? There are no answers. There are no
clear but the scenarios definitely help, sir. I mean, you've tried to put out multiple scenarios, which definitely makes sense. Thank you so much for a comprehensive answer. So moving to the fourth question, you mentioned focus on earnings power and delta in earnings. What is the real difference between both? And if you can please help with the real life business example.
Okay, so earnings power is the ability of the company to churn out, profits at a high ROE year after year, year after year. So I would say HDFC Bank has very good earnings power. It has the ability to, churn out 15% growth every year. Or an Asian Paint has a very good earnings power, right? It has year after year, they can compound your money. Year after year. So HDFC Bank, people knew about it 10 years back also. In the same way, we know about it today, just that the size has gone up multifold. But people never participated in HDFC Bank because people said, there is no fun in it, right? So people, so stocks like HDFC Bank, Asian Paint, a lot of the MNC companies, they have what is called as an earnings power. They are leaders in their sector, running the business in a very stable manner and enjoying, growth tailwinds, right? Earnings delta is where the real money is. Now, if you buy an HDFC Bank, you can compound your, portfolio at a 12 to 15% CAGR, right? Predictably, you can compound. And if you buy them during bear markets, you can bump up that return by a few percentage points. Earnings delta is what I'm really interested in. Earnings delta is not growing at 15% predictably. Earnings delta is when somebody who was in a loss suddenly comes in a profit. Or a company that was growing at 10% suddenly starts growing at 30%. So earnings delta is where the big re-rating happens, right? So earnings delta is more like, so you can call it, the earnings power as the speed, and earnings delta is the acceleration. So that is how I would put it.
Makes sense. Thank you so much, sir. So moving to the next question, in your blog, where you mentioned focus on neglected stocks, a 50 plus a 52-week high combination. In this regard, the student wanted to ask, what are the broad indicator to understand whether a stock has been neglected? And when he saw the example mentioned on the blog, they were trading at a price band of 3 to 7 years, but that generally also happens with many cyclical stocks. So he basically wanted to ask, apart from price range, what other factors you keep or you keep a track of in terms of understanding whether the sector or that particular company has been neglected?
Yeah. So one is definitely the price range, and even for cyclicals, right? That's why there are very successful cyclical investors. I think some of you might have also come on this show of yours, uh, and that is exactly what they do, right? So if stock is not going anywhere for 3 to 7 years, a cyclical stock is also a very big opportunity to make money, because when the cycle turns, right, this neglect is what, neglect means what? The stock is under-owned, right? It's not there in anybody's portfolio. And so there are no sellers left. So there is no seller. So all the incremental buyers only are there. And that is why the stock gets re-rated, right? That is what exactly happens in the market, right? So one of the ways definitely is to look at price, and, the price behavior over the last, depending on what time frame you are trading again, 1 year, 2 year, 3 years, 6 months. So neglect can be, I think the best indicator remains the price. So when neglect meets a catalyst is when the most potent moves happen. So the other way to look at neglect is, obviously today it's very easy, because, if you're active on Twitter, then you will know what stocks people are talking about. So if this stock is not being spoken about on WhatsApp groups and on Twitter and all of that, then you can be very sure that nobody is there in these stocks. Because nowadays it's very easy to figure out, information is flowing at such a pace that you can easily figure out if a particular stock or sector is neglected or not. So that is one. And then generally media pessimism, nobody will be in the media will be talking about it, right? So that this is what was happening with pharma in the last 2-3 years, right? So stocks like Sun Pharma, Cipla, Lupin, nobody was talking about it. They were a very good example of neglect. And over the last 1 or 2 months, led by their results, they have been re-rated like anything. And that re-rating is continuing even as we speak today, right? Pharma in the last 1 or 2 months, 1 month has suddenly come back into the game after this quarter results, right? So pharma is a great example of that, because if you look at the price action before this, these stocks have gone nowhere, right? And nobody was talking about them, and people were getting frustrated. So all of those, are indicators for neglect.
So much. Last few questions, sir. Please
Sure.
Bear with us. So you mentioned in one of your replies on a tweet thread that one of the key elements in re-rating is cash flow improvement. The market keenly watches cash flow twice a year and disproportionately rewards those cash flow growths faster than profits. In case of growth businesses, free cash flow gets depressed over a very long period, and in such scenarios, does it make sense, or in such scenarios, how does the market evaluate cash flow generating capacity?
Yeah, so I tell you, see, the most favorite variable for the market is sales growth. If you have sales growth, then that will trump everything as far as the price action or the market's reaction is concerned, right? And the second biggest thing is margin. Any improvements in the margin from a depressed situation to a turnaround kind of a situation, like a margin which was hovering at 3-4% for a long time, suddenly the margin becomes 5-6%, because a change in the margin, even with the same sales, has a multiplier effect on the earnings. So even if the sales remain the same, but the margins jump from 2% to 4%, your profit will double, right? Your profit will grow 100%. Your sales has gone to 0%, right? So margin is something that the market watches, and cash flow is something which is, a good to have situation, right? So if you have an option where two stocks are similar and one stock has very good cash flow and the other one, not so much, then we can pick the one which has a better cash flow, because generally institutions will back a stock which has cash flows. Institutions will typically not back a stock which has and this was the problem that even Amazon had, back in the days, right? So Amazon is the exception that everybody quotes, that, it was a company which had negative cash flows, but they did well and all that. And Amazon faced this problem of market neglect earlier. Markets didn't like it. But then I think Jeff Bezos over the years explained to the market that the cash flow, negative cash flow, is not because the business is inherently unprofitable, but it is because he's investing that money back into the business. So it was not that the cash flow was not there, it was that the free cash flow was not there. So there is a difference between negative cash flow, and free cash flow, right? So ideally, a growth business, right, should not have much free cash flow, right? So a cash flow, in the sense, when you look at the cash flow statement, you have to look at the cash flow from the operating, earnings part, and there you get a lot of clues in terms of whether the problems are because of receivables or those things, or because of, or some in businesses will be high working capital businesses. So it is again, dependent on what type of a business is it. There is no blanket statement. But having said that, cash flow comes much later, although it is very important for a long-term, very long-term investor. But if you're playing one cycle, then the important variables to focus on are the sales growth and the margin trajectory.
Very much. Thank you so much. I think the next question you already covered in the previous one. So we're going to move to the eighth one. What indicators make you understand whether the market is currently oversold or overbought in terms of regions? Playing liquidity premium and discount in small caps in bull and bear markets. In bear markets, they are oversold, and in bull market overbought. Hence, small caps make very good market cycle play.
Right. So, see, it's very difficult to predict the overbought situations, because markets can remain overbought for a very long time. So all bull markets are, they remain overbought for multiple years, right? So overbought is always difficult to judge. Oversold is very easy. Oversold is, you can look at it in different ways, right? So one of the best examples of, figuring out oversold is to use breadth. So I spoke about the market breadth concept earlier. So if the breadth of the market goes into single digits, you can be very, very sure that a turnaround is about to happen. So if the number of stocks which are below, let's say, the 50 EMA or 200 EMA hits a single digit mark, you can be, because you can go back and study this in history, right? So you can be very sure that the turnaround is around. You might not be able to nail it to the exact day, but I'm sure you can nail it to the exact month, right? Because when the breadth turns so bad that only, let us say, 5 to 6% of the stock in the entire market are, above the 50 EMA, or in other words, 95% of the stocks are below the 50 EMA or the 200 EMA, then you can be very sure that the market is oversold and a bounce is going to come. Now that bounce will definitely come, but it might be followed by another low. It's a different story. But from an oversold concept point of view, it's very easy to figure out when the market is oversold. Overbought is a very difficult game, because markets can remain overbought for years together in a bullish phase.
Thank you. So, and the last question, and there are just 3 career advice questions. How to detect sectors of new cycle? At this point, it has been mentioned by a lot of practitioners that being positioned in right sector is more important than stock selection, right? So his question is, from observing all-time high and 52-week high across sectors, is there any way that we can generate an idea whether the sector is turning around, or should we run some kind of filters or quantitative checkpoints or quarterly results to understand whether a sector is being played out well?
Yeah, see, the ability to identify the sector or the theme which is going to be, the darling of the market is a very, very lucrative thing. Okay, so you should be doing everything that he has mentioned there. You should be willing to do everything to be able to predict that, right? So you don't know from where your answers will come. So the answers may come from the quarterly results, or the answers may come from some news event. Like in case of defense, it was the idea that government is now going ahead with import substitution, or the government wants to push wants to make indigenized weapons and all of that, right? So the thing may come from news, the thing may come from earnings, and if both of them you're not able to do, then you can definitely look at the monthly or quarterly or 6 monthly winners or 52-week high list or any of the different technical parameters. The problem with the technical parameters is slightly that you'll be slightly late to the party, which is not a problem, but obviously there's something, there's significant thing you're leaving on the table. The 52-week high, all-time high and all, by the time they come, these stocks would have already moved up by 50, 60%, right? So then just because the stock is hitting 52-week high, you cannot go and buy it. So then you have to wait for it to consolidate and, find a, decent entry point. But yeah, so you have to, from where the answer will come is very difficult to, tell you. But most likely the fastest way to do it is to be attuned to the news, I would say, the corporate announcements and the news, right? So I think Titagar Wagons, right, one of the big winners of this rally, I remember reading an innocuous, PPT about 6-8 months back, or I don't know, about 8 months back, where they have clearly mentioned there that the size of the order, right? The size of the order book is multifold of what the top line of the company, was even now and even 1 year back, right? So it was no brainer actually, but it was a stock which was a neglected stock again, right? Titagar Wagon has been in the market for ages, right? It only goes up during the railway budget and then it falls. That was the story of that stock. Right? But now a game-changing thing happened. So you can find the answers in corporate announcements, in the PPTs. That is where you will find the answers early. The 52-week high and all, you can still find out. If you're lazy and you're okay to not, put in the effort, then the 52-week high and all are good shortcuts for that. But but only if you want to be able to hold on to those stocks for the big gain, right? Then you have to come back to the source. So the best sources are corporate announcements, con calls, presentations, as well as the day-to-day news. So you have to be attuned to the the business news. A lot of people say business news is crap, right? But news channels sometimes might be more attuned to the different kind category of investors, but business news in itself, right, company specific news is very valuable. So company specific news and management interviews, these things are very valuable because you can get 1 or 2 small insights which can make you 100 200%, right? So it takes being involved with the market to be able to really identify these sectors before the rest of the world does.
Got it, sir. Thank you so much, sir. Thanks for all the detailed answers. Now, a bit of career advice to these young investors. The first one is, if you can please help us with any reading recommendations which can help us understand Indian markets a lot better.
Yeah, so like I said, I am a more I've graduated into a more and a person who values actual practical knowledge more than the book knowledge, right? I have read all the books out there because so this is a learning which came organically, right? So I've read all the you name it, and I would have read so there's no market book that I might not have read, right? So that is again because of the passion and the interest I had in the markets, right? So I started investing when I was 15, 16. That is when I started my journey at a very early age, and a lot of you are around that age. So today it's normal, but in 15, 20 years back it was not normal. So it was the passion which kept me devour anything and everything, and I've tried all the different styles, but like I said, the reading recommendations you will find anywhere and everywhere, right? So so within that, if I have to tell you one book, I think it is Peter Lynch's book, right? One Up on Wall Street. That book, like if you read it seriously, right? If you read to understand it, some of the lines there are worth lakhs, I would say, right? Some of the lines that, because the concepts, right, that he speaks about, if you really understand what he's trying to say, but you might have to read that book 3-4 times, and you have to also see every book, right? Your understanding of the book will change as you mature as an investor. When I read Peter Lynch 10 years back versus when I read 5 years back versus when I read now, I will be able to extract completely different output from it, right? When you're reading as a newbie, you will not be able to grasp that. You'll be like, it's very simplistic, right? But in the end, it is very simple. But to understand the importance of that simple message and to be able to apply it, it takes a lot of maturity and a lot of tuition fee and so that is, if there is one book, I would say that is the book. But I would encourage all of you to do what I mentioned earlier, to do deep dives on your chosen strategy, and figure out, do case studies on what exactly happened. Look at big winners in the market. Do a simple case study. Just go 1 year back, 2 years back, last 1 year, which were the big winners in the market in 2023, in 2022, in 2021, right? And study what led to these winners. What happened, what was the market context, how did the stocks move, in different phases, in a bearish phase, in a bullish phase. So that kind of a learning will really trump anything that you read in the books. That is what I would say.
Thank you so much, sir. The precedent part which you mentioned at the start of the lecture. Absolutely.
Yes.
Sir, the second piece of career advice is any particular mistake which you probably would have made in your career and you would want us to avoid this, these young budding investors.
No, I have made many mistakes, and you can't avoid the mistakes. So I think that's a very, maybe it's not the right way to look at life and career and things, right? Because you have to be willing to make mistakes, right? You have to see, like I said, you have to see, if you look at any great investor, right? Even if you ask them, the secret, right? They tell you the secret, right? You will not be able to replicate what they have done, right? Because you have to see, the thing has to go into your subconscious. See, there is a mastery level, that is what, we all, including myself, that, you have to aim for the mastery level, right? You can easily be a mediocre investor. Everybody can be an above average investor, right? No big deal. But if you're aiming for mastery level, then you have to make the mistakes. And because only when you make the mistakes yourself will you understand it. But the only advice I would give is, make the mistakes you can afford, right? So don't do stupid stuff like leverage, like FNO trading, which can completely wipe you out. You can even do that when you know that you're starting out in your career, and let us say you just earned for 1 year, that you have some savings. Okay, blow it up, because only then will you learn. But once you have built a reasonable size of capital, right? Don't do things like Charlie Munger says, right? You don't do don't do stupid things, right? Like which will kill you. So make mistakes, but keep them affordable, right? So, but there is no avoiding making mistakes. So if you go with the mindset to avoid making mistakes, you'll never take risks. And if you don't see, the whole game of the markets is risk. You have to be willing to take risk, and you have to learn how to manage the risk, right? There is no, and that is when you learn. So the concept of avoiding the mistake is something, I would not encourage you. Experiment, and only then the learning will happen. Otherwise, you'll just be left reading books, and finally you'll go and invest in a mutual fund, which any which way you can do, right? So go for the mistakes, but ensure that they are not huge mistakes.
Thank you, sir. And the last one, one crucial life-changing advice which you may have got in your career and you'd like to share with us.
Yeah, I think it is the concept of which I already spoke about, right? It's the idea of focus, right? It is the idea of focusing, picking something and going all in. So dedicating all your energies to one thing has a massive impact in your performance. The mistake that most people make, right, in life is that they are looking for a balance, right? So there is no, the concept of balance itself, some people may or may not agree with it. It's a very personal opinion, So the idea that I will do this also, I will do that also, and I will do a third thing also, you can do that. There's nothing wrong with it. But if you are trying to excel in something, then you have to focus. You have to figure out that, okay, this is the one thing. So if you want to, get a six-pack, right? If that is your journey, then you have to focus on that. You have to build your entire life around that. Whether it's your diet, whether it's your regimen, whether it's your timetable, whether it is your gym, everything has to be and only then you will be able to achieve it. And that works for anything. So that is one of the big advice I got. I don't know from whom, but maybe it's a culmination of what I've read and seen and experienced. But from the time I started dedicating all my time to focusing on a particular thing, the improvements are orbital in nature. So you don't improve by 1 or 2%, right? You improve by 10, 20, 30%, so it's multifold improvement. So don't spread yourselves too thin, right? Whatever is the project, pick one project and give your everything to that for whatever duration you are working on that. So that would be my advice. Just go for focus.
It just reminded us of a wonderful quote by Charlie Munger: take a simple thing and take it seriously.
Absolutely. Some of these simple things, right? That's exactly what I was mentioning about Peter Lynch also, right? The line will look so innocuous and simple that you don't know how much depth is there in that. Even the Buffett line, right? He says, I'll tell you how to be rich. Be fearful when others are greedy and be greedy. It's such a simple line. It is so abused. It is used so much in the markets. But just think about it. If somebody is able to follow it throughout their investing career, you can't help but become rich. So it's not the line, right? It's the implementation, and it is how seriously have you taken it, right? So there is an intellectual understanding of things, and there is understanding in your heart, right? They're two different things. Intellectual understanding is simple. You read a book, you understand. But to really understand it in your bones and in your heart, that is the game changer.
Thank you so much, Sir Prabhakar sir, for such a wonderful, wonderful session. It was genuinely mesmerizing. I'm sure we will be watching the recording again, and we would hope you would give us a similar opportunity of interaction in future.
Absolutely. It was my pleasure talking to all of you.